This is the 5-year chart, and you can see up here, though, spending is starting to level off a little bit, and I think because of inflation, like I'd mentioned. But it is still strong and trending upward. When we start to see that roll over as well is when we get concerned about recession starting. And this is on a real basis. So we have the nominal, which is the actual dollar spent, and then real is when it's adjusted for inflation. And even adjusting it for inflation, we're showing a leveling off here, but it certainly isn't dropping so far. And there's also, if you look, there is a lot of month to month or quarter to quarter noise on this where it does drop a little bit, then rebound. So if we're not in a recession now, when do we think we're going to see a recession? It'll take interest rates moving higher. If interest rates move higher, then it's more expensive to borrow money. So you think about it individually. If you're out, let's say, buying a car, and I know cars are ridiculously expensive today, and somebody offers you a loan at 0% or even 1 or 2%, it might be worth it. When that loan becomes 7 or 8%, you're probably going to have second thoughts about taking out the money. And businesses think the same way. If Apple, Microsoft, whomever can go out and borrow money. Now, these are bad examples because they have all sorts of cash and don't necessarily need to borrow, but if they can borrow money at 1 or 2%, I guess to bring it back, let's think about some local business that does require a lot of capital to operate, has to go to the bank to take out a loan at 2 or 3%. Not a big deal when those loans get to be 7 or 8%. It is a big deal, and obviously economic activity will slow down. Companies cannot grow as quickly as they were previously, and this is when businesses start to cut back on spending, including employees and wages. This can be somewhat self-fulfilling too, and we're starting to see some layoffs, and it's more anecdotal versus anything showing up in the data, where some companies, even the large companies like Google, are cutting back in their hiring. There's a lot of hiring freezes. There's been some layoffs, and it's because people anticipate this recession coming. Well, there really isn't anything that's happened yet. They're expecting it to happen, and so by starting to cut back now, they're kind of forcing themselves into it, and then we'll see more and more of that, I would think. Our thought is that we will see a recession as the Fed raises interest rates and continues to. If you listen to what Fed Chairman Powell said last week, where interest rates, they expect to continue to raise interest rates even if it causes pain for families. These are his words. It'll probably lead to higher unemployment. So the thought about 6 weeks to 2 months ago is the Fed was going to raise rates through this year. Then next year things are going to slow down and they'd be forced to cut rates. That's why interest rates dropped quite a bit and the stock market rallied. Now we're seeing the opposite with what Powell came out and said, that they're okay if it does hurt employment in the short term. So indications now are that the Fed will continue to raise interest rates next year, and we expect interest rates to continue to move higher. And I think that'll force us into recession probably the second half of next year or sometime in 2024. There's a possibility it could be a little bit sooner, but I think next year we're probably going to see this because we do expect rates to keep moving higher. So one of the things that affects inflation, and so that's why the Fed is committed to continuing to raise interest rates, is they want to fight inflation. What's causing inflation is what's called the M2 money supply. That's the amount of money that's available in circulation, coins, currencies, savings accounts, checking accounts, generally short-term type cash. With all the stimulus payments that went out during COVID, you can see that the money supply was greatly increased. The Fed did their quantitative easing where they're buying bonds. So they were buying bonds and holding them, so that was putting more money into the system as well. And you can see, that the traditional definition of inflation is too much money chasing too few goods. And so you can see how there's a lot more money in the system and same amount of goods, hence inflation. So it really should be no surprise. We are starting to see the money supply level off here. And the Fed now has started on their quantitative tightening, where instead of buying bonds, they're selling their bonds back, and that's sucking money out of the system. They just started to do this in May. They really haven't done it in earnest, and they're going to start to do it more and more in September. In October, also by raising interest rates, it reduces the money supply. So until we see this start to drop, we probably won't see much of a major downtick in inflation. What the Fed's fighting against, though, is the fiscal policy of our governments. So this is federal government current expenditures. And you can see that through time it goes up as we'd expect the government to spend more and more money. We all know that they've been spending more, and things cost more money, so obviously inflation plays into this. A lot of money went out during the pandemic and COVID, and then since then they've continued to spend money, roads, bridges, education, so on and so forth. And then some of the bills that they've recently passed too, it's going to shoot this up even higher again. So despite the work that the Fed is doing, they're really fighting against the other part of the government, Congress, and the president at this time when it comes to money supply. That's why we expect inflation to stick around for a while and the Fed to continue raising rates. Looking at recessions, how long do they last? Everybody hears this R word and they're really afraid of it, think it's not a good thing. And obviously, everybody in this room remembers some of these. I mean, we've seen some very nasty recessions in the last 20, 25 years, and going back further, but especially somewhat recently. So they're in fairly recent memory. The average recession since 1854. So that's going back quite a ways. Obviously, our economy was very different. Kind of discount that number. So that's been 17 months. But from World War II, the average is about 10 months. So even let's assume that we're in a recession now, which I don't think that we are. If it lasts 10 months, we've already been in one for 2 quarters. We're more than halfway there, but I don't quite think that's the case. Recessions are not the same as a down market. The stock markets perform very differently during different recessions. So it's hard for us to look back and say every time there's a recession, here's what's happened. The stock market's peaked here, bottomed here, so on and so forth. And through time, the market's actually made money, been positive during certain recession scenarios. Now this is a little bit different. If you look at the chart on the far left there, we're coming out of World War II. So there was a lot of spending. Everybody was coming home from the war, spending money, times were great. So that's really no surprise. That carried over into the 50s. The one I thought was interesting is the early 80s, which they're comparing to now when inflation was. That's the last time we saw inflation as high as we have now, is even a little bit higher. Energy prices were higher. The stock market did relatively well. Now, during the 70s, the stock market was pretty flat. That was mostly a lost decade. And so it was kind of a loaded spring that was just bouncing back into the early 80s. And then the last couple were going back to 2000, 2001. Everybody remembers 07, 08. It's pretty nasty. And then the little COVID recession, I call it little. It was major at the time, but it happened very quickly. Then the market bounced back very quickly. In those 3 months that we had a recession, the market was down 9%, but then 3 months later, it rebounded fully. So kind of discount that one as not being the best indicator. Pulling out more charts here to take a look at just as examples, like I mentioned, 1980, and the red line roughly shows where the stock market was. This is a Wilshire 5000, kind of use it as a proxy for the overall market. It's the 5,000 stocks. Today it's like 3,500 stocks. It tracks fairly close, say, to the S&P 500. Includes more of the small mid caps, but overall the performance is not that different. You can see as a recession started, a lot of times we don't know we're in a recession until after it started, and it's kind of a look in the rearview mirror. The market moved higher, and then it dropped rather dramatically, but before the recession was over, the market had already rebounded to where it was prior to the recession. So that one wasn't too bad. If we look back into the 81, 82 recession, kind of the same thing. It drifted down, but before the recession was over, it already had rebounded and then took off. So this is a 4-year chart. So this recession, which is a relatively long one, went from the middle part of 81 to the later part of 82. So that was 15 or 16 months or so, a little bit longer. But the stock market in that period of time, obviously, didn't do real well. But then towards the end, people must have saw a light at the end of the tunnel. This is back when Paul Volcker was raising rates to fight inflation, which Jerome Powell's trying to kind of mimic today. Not sure if it's going to happen as well or not. But at that point, people said, hey, this is actually working. It takes a while for the Fed action to catch up or work its way through the economy. And so by this time, I think most people said, okay, this is actually going to work and things look brighter. I didn't hit that. Going back to 1990, kind of the same deal. This is a longer one. This one lasted, well, this is a real short. So that recession lasted, 8 months or so. You can see that the market did fall rather dramatically, but then recovered rather quickly as well. By the time the recession was over, the market had recovered. Obviously, there was some pain in the meantime, so you want to be prepared ahead of time. This is 2000, 2001. So if you notice up here in early 2000, I don't know, a lot of you might remember the tech bubble. There was the boom. All these tech stocks were doing great. Just the index level, just remember the 45 here. And the market had started to fall before the recession, which I think a lot of people remember. It was very overvalued. The NASDAQ lost about 80% of its value. During the recession, the market fell. Then it continued to fall after the recession as well. So what the stock market did was somewhat separated from what the overall economy did. And eventually it started to work its way back up. And if you look at where it was right before the recession, it finally recovered in about 2005. So there was about 5 years there of just really no growth in the market, in the overall market. Now, some of the individual stocks did fine. Some of the tech stocks did awful during that period and have just recovered recently in the last few years. Taking a look at the 07, 08, kind of the same situation. So we look at where it started. This is a different time too. We had the housing crisis, the Great Recession. So this was a major downturn in the stock market. It really got ugly into 09, then started to recover. Finally recovered in about 2011. Got back to where it was. If you remember before, I said remember that 45 number. So that's right here. So if you'd invested money in the year 2000, just let it sit, and we're not factoring in dividends or anything, it got back to the same point 2010 and kind of fell again 2011. There's 10 or 11 years there where the money didn't do anything in the stock market. The stock market doesn't always go up. That's why they call it the lost decade. It's all a matter of timing. Now, if you're really smart and sitting on cash and invested it here, 2 years later, you would have doubled your money. But it's all timing in the market. So we're going to talk about ways of finding protection should we see a market downturn. This is where I'm going to get into some of the specifics, give some ideas, some things that we're looking at. Like I said, this is not meant to be individual investment advice. So if you want to discuss these things more detail, please let us know. So we have bonds. So we're talking beforehand about a 60-40 portfolio, and this worked extremely well during the recession. Well, we'll talk about it more here in a second. It's not working so well today. So I'm going to even cross that one out, but we'll still talk about it. There are some stock strategies that I think would do well in a recession. Then there's a lot of alternative things that we're going to look at. We'll get into more detail here. So like I mentioned, historically, bonds have worked really well when the stock market falls. What happens, people get worried in the market. They take the money out of stocks, they put it into bonds. That pushes the bond prices higher, bond yields lower. That's why the 60-40 really worked quite well in 07 and 08. We've seen a 40-year bull run in the bond market because if you think about it, inflation was really high 40 years ago, back in the early 80s. So interest rates were high, kind of where we're heading today, probably even higher. And then it slowly, interest rates move lower. So it's the teeter-totter, so as interest rates move lower, bond prices are going to move higher. So bonds have had a great run for a long period of time. The problem with that is we probably won't be seeing that again anytime soon because inflation is still so stubbornly high. The Fed's raising interest rates. We're seeing bond prices move up quite a bit. So the 60-40 portfolio, we look at the first half of this year, really didn't work well at all. This is through the end of July, and really these numbers were worse through the end of June. July wasn't a bad month for the bond market, but the Barclays Ag market was down about 8% on the year, about 9% year to date, which isn't awful. We've seen stock market fluctuations 30-40%, but bonds, this is supposed to be your safe monies, losing 8-9% on a year. Then you get into longer dated bonds. These are the ones that did the very best. They're down 19%. That's huge if you're buying a bond portfolio, to lose about a fifth of your money. Again, that was down worse at the end of June, and then recently, the last few days with what we've seen, it's down more than that. I mentioned the high yield master. That's the high yield index. A lot of people get carried away with these. They say, oh, high yield bonds, these are great. They're yielding 7 or 8%. They look really super good. And some years high yield bonds do really well. They have a higher correlation with the stock market than the bond market just because they're more impacted by the economy and business conditions. But they had a negative first part of the year, and even tips overall were down. They don't provide the inflation protection quite directly as some people think they do. They hear tip and think, okay, this adjusts with inflation, but there's more, and these are a little more complicated, so they do fluctuate in price quite a bit. If you look at the ETFs, there's tip, which is the longer term one. It did a lot worse than this. And there's the shorter term tip, the STIP, which did better. It was still negative, but only slightly. So tips are still government bonds, and they're susceptible to what's going on in the treasury market. So that's why we don't like bonds. CDs and savings accounts, it is a way to keep money safe. If you're looking for something very short term, this is a good way to do it. I found the average CD rates as of a couple weeks ago from bankrate.com. They just take a national average, 1 year at 0.61, out to the 5 year really isn't much higher. You can go out, and there are some places offering a 1.5% or 2% 1 year CD, but then you're moving between institutions, which is fine. But remember that inflation is running at 8%, give or take. So if you're earning 0.6%, you're losing your purchasing power of about 7.4% per year. Again, if you have an expenditure coming up, and it probably doesn't make sense to put money into the stock market and lose it, if you're buying a house or a car or something like that, a CD is a fine place to park it to keep it safe. But over longer periods of time, you're really losing your purchasing power. And historically, a lot of banks, we'd see CD rates move higher as the Fed would move shorter term rates. They're just not doing that now. I don't think the banks need the deposits like they once did. If they're not loaning out money, they don't need the deposits, so they're not willing to pay a whole lot. So CDs, savings accounts kind of fall into the same category as well. If you look to the stock market too, stocks in recession or a down market tend to do bad. They say a lowering tide, brings all ships lower, or whatever that saying is. I know I kind of butchered it there. So dividend-paying stocks, or any stocks for that matter, are subject to market fluctuations. But during a recession, the more growth-oriented stocks do a lot worse than our old stable stocks that really are kind of boring and just make money year in, year out. If they're strong established companies, they have strong stable earnings. So we think dividend-paying stocks are a good way to go. Be careful. You have there's a lot of dividend-paying stocks out there today that are paying these huge dividends. But if you look at their numbers, you get into their financial statements, these dividend payments are unsustainable. They're paying out more than they're bringing in, which they can do quarter to or two, but eventually that's going to catch up and they can't do it. So you really have to make sure you're buying high quality. Do have to put in a plug. Created our I did this a few months ago, secured retirement equity income portfolio. So we use our core equity quite a bit, which is our overall equity portfolio that really tracks the S&P 500 quite closely. This one is meant to be a little more boring, a little more stable. We do find high dividend paying stocks. In this one, the dividend yield at the end of June was over 4%. Today, with what the market's done, it's a little closer to 4%. Very low priced earnings, price to book. We don't expect this to grow. When the market's going up, we wouldn't expect this to go up as the market. But on the other side, when the market's going down, we wouldn't expect this to go down as much as the market either. And our thought is, over the next few years, we very well might see positive market returns at more mid-single digits at best, versus what we've seen the last few years, which is mid-teens. So if you're getting a 3 or 4% dividend yield, that would really help prop up those returns quite a bit. Another thing about this portfolio too is we're really well diversified within sectors. There's a lot of equity income portfolios out there, or high dividend paying portfolios. Kurt, I'll get this to you. You don't need to take a picture. You can though if you want. You look at some of these other portfolios, and they load up on things such as utilities and financials. Well, with rising interest rates, utilities are very capital intensive. That's going to hurt them. Financials, if we hit a recession, now with higher interest rates, they should do well. There should be that larger spread. We're talking about how they're not paying very much for deposits. Well, they should be charging a lot more for loans. There's a larger spread, but financials are also very sensitive to the economic cycle. So if we're headed towards recession, financials might be difficult. So you look at a lot of these portfolios, and they're just loaded up in 2 or 3 sectors. This is fairly well diversified. It's showing our finances being very high. Real estate is grouped into this. And so our real estate's about 10%, our finance is about 15%. So the benchmark here is just the S&P 500. We're not even benchmarking to a dividend type benchmark. When you look at some of the finance companies that we're into, it isn't just the traditional. We do have banks, of course, but there's insurance companies. Our real estate's different. I think we're going to see some problems, especially in residential real estate. I don't think it's a surprise. We're probably going to see a bit of a recession. I think office spaces are a bit of recession. So you have to be very selective in what you're buying there. We remain overweight energy. Energy is making a ton of money right now. As we're all aware, we're feeling the pain at the pump. So we are overweight there. Materials, and some of this is a bit of an inflation play as well. So anyhow, that's a little bit about our portfolio, 35 stocks. So if you're interested, let us know. Another way to find protection would be fixed index annuities. The way these works, there's no downside risk. The performance is capped to the S&P 5, well, to an index, I should say. Can be, S&P 500 might be an example of one. As interest rates move up, there can be higher interest credit ratings. So this is a good way. And from here on out, I'm going to talk about a lot of ways to participate in the stock market, but also protect yourself on the downside. So if the market does take off, you're able to participate in that. But if it does go through a downturn, then you're also protected from losing money. And then with the annuities as well, there is a potential for unlimited lifetime income. People are living longer now, so you can annuitize these down the road. That's kind of a secondary feature. I would mention these too as an alternative to bonds. You're not subject to the market risk as much. There's obviously different types and structures, and there's pros and cons to these. But another way to look at it is universal life, kind of the same thing as the annuity. Performance is tied to an underlying index, such as the S&P 500. There's other ones out there. They have what are called caps and floors. So if the market's up X percent, you probably will not be up quite that much, but there's also a floor where you cannot lose money. Then that participation rate, so it's a percentage. So if the market's up, I don't know, whatever percent, your participation rate might be 65%. So but in return for that, you do get the floor. So there is a protection. It is a life insurance product, so you have to be in good health for the underwriting with this. There is the death benefit too, if you want to leave money for heirs. It's nice. Then the cash accumulation, and so you have the money that you put forth towards the premium, so much as the cost of insurance. The other part is your cash accumulation. Then you have the ability to take loans on that or even withdraw it. So let's say the S&P 500 does well, you're participating in the market, your money grows, and you decide to take it out, you can do that. Not the full amount. There's obviously a lot of asterisks with these, and we'd have to explain it in much more detail. I did want to talk about structured products a bit. I love these. I think they're kind of mind-blowing. You're going to look at these and think I'm making some of these numbers up, but no, these are real. This is what happens in the market. The first is a buffered ETFs. A lot of the clients we work with use these extensively. The way they work is there's a buffer and a cap. And so the return is capped, and again, they're tied to an underlying index, generally the S&P 500, but you can buy these for the EM, the emerging markets, the EFA, the foreign markets, NASDAQ if you want to, gold, you name it. We tend to stick with the S&P 500, most straightforward. They are tied to the market return. There is a capped return, so if the market returns more than a certain amount, you're limited to how much you can earn. On the downside, though, there is what's called a buffer. So in a lot of cases, it's maybe 10 or 15%. So if the market's down 10%, you don't lose anything. If the market's down 30%, you only lose 20%. So it does provide some downside protection there, and I'll show you some examples in a minute. Other ones work where you participate in the first 5% of the downside, and maybe the next 25% you don't. Again, there's a cap, and on those, the cap tends to be a little bit less. I like examples, so this is one. And these are from First Trust, one of the partners. There's a lot of people put out. These are exchange-traded funds. We use these as a total portfolio. You can buy these individually. They work on an annual basis where they run for 1 year, then they automatically roll over, so you can stay invested, but they're ETFs, so you buy and sell them at any time. This one's what's called a shallow. So it had the 10% buffer. The cap was 11.7%. So we bought a number of these a couple of years ago, and with what the markets did last year, we're capping out, which is great and fine. Everybody's happy with that. So this is the July, and you can see where the market over this time period was down a little more than 10%. This one did lose money, but it lost about 1.5%, but the market was down about 11%. So it provided a lot of downside protection. In this case, this is the deep. And on the deep, the cap is smaller, the buffer doesn't start till the 5%, so you're on the hook for the first 5%, but then it gives another 25%. So let's say that the market's down 35%. You can do this, actually you'd be down 10%. If it's down 30%, you'd only be down 5%. Same thing, the market was down 10, 11%. During the time period, you were only down 5%. I'll tell you a little trick here, is that they have these out there for every month, and you can buy and sell these at any time. If you look at the March and February, about a month ago, this has changed a little bit, but it's still fairly close. A lot of these are trading right near the 5% downside. So the ETF has already experienced that 5% downside. So if you were to buy this now, let's just forget all this and pretend like this is going forward. If you were to buy this now, you'd have 25% downside protection, and then your cap's at 7% plus the 5%, and these change month to month. So we'll just use this as an example. You have a 12% upside with a 25% downside protection. So a lot of it comes into timing when you want to buy these as well. There's also notes. I use the same chart again. You can buy these instead of buying the ETF, which we like the ETF because they're completely liquid. You can buy them on the exchange at any time. They also make these as notes similar to a bond or a CD where they come due at a certain time period, whether it's 1 year, 1.5 years, 2 years, whatever it might be. Different indexes, but really the same idea. We also have what's called a barrier note, and that's the growth is tied to an index. They also create these where they're tied to an individual stock. I don't like that because it doesn't provide the diversification. They generally provide better terms. If you have a very large stock position, it can be a way to somewhat hedge that or capitalize on it. But we tend to stick with the indexes. The growth can be capped or uncapped. There's different types of upside participation. Again, I'd mentioned the 65%. Sometimes it can be over 100%, like 120%. But there is a principal barrier. So the way these work is that if there's a barrier on the downside, if that barrier is breached at maturity, then you fully participate in the market downside. If it's not breached, then you still have principal protection. This might be an easy one to show with some examples. It's come from a number of issuers. So this first one, issued by JP Morgan, the underlying is what we call the lesser of. It's the S&P 500 or the Dow Jones Industrial Average. So at the end of the term, this particular case, 3.5 years, they look at both benchmarks. Whichever one's performed worse is which one you're going to be tied to. The upside participation is 117%. And it's uncapped, max return. And then the downside protection is 60% of initial at maturity. So if one of those two indices is down 40% or more, you would have broken the barrier and you would have lost that amount. But if it's down, say, 39%, you'd get your full principal back. And let's just say the market heads straight north from here, you'd have 117% of the market upside. This is a different one from UBS. I personally would not do this one, but just to show you how these are structured. This is a lesser of, that's the Russell 2000 small cap index, which actually is down a lot lately. Then that's the SOX 50, the European benchmark. 2 years, 170% upside, uncapped. This one has a buffer on it. Instead of the barrier, it has the 15% buffer like I was showing before. So if the market's down, if the lesser of those two is down 15%, you wouldn't lose anything. If it's down, say, 20%, you'd lose 5%. But if the markets just take off and go crazy, you'd have 170% of the upside from there. Another example here, too, this is from Barclays. 5 years, lesser of the S&P, Russell 2000 or the NASDAQ, 155% upside, uncapped. The downside protection is 50% of the initial. So if the market's down 50%, the thing to remember is the market right now, we're down, higher teens. So at this point, if you think the market's not going to be down 50%, I guess we'll call it 67, 68% from the highs we saw in January. Why not look at something like this and you have more upside. This is the type of thing, though, that you want to buy. You can get out of these at any time. You're at the mercy of the market. So your pricing might vary, but if you think the market's going to be higher 5 years from now than where it is today, this is a good way to get a little added return out of that. We also have income notes that pay a coupon. This is similar to a bond. However, they're tied to an index, or they can be an individual stock. Again, we prefer the indices. There's a principal barrier, and they can be callable. So we'll look at some examples here. So this first one, it's the lesser of the S&P, Russell 2000, or the NASDAQ. 3 years, non-callable for 6 months. It has that 50% barrier. The coupon rate's 8% per year. The way it works is if the market or the index, I guess one of those three, is down more than 50% from where it started, it will not pay the coupon for that month. But the principal barrier only concerned with where it is at the end of 3 years. So if you don't think the market's going to be down 50% in 3 years, this would be something to take a look at. Again, 8%, so you're more or less keeping up with inflation with this one. This is another one, 3 years, 3-month non-call, 60%. This one has what's called a monthly with memory. And so if it's 80% initial, so there's only the 20% downside that's protected. If it happens to drop below that and not pay, but the next month it's higher, you get the previous month's and that month's. So it's cumulative, where the other one is not, and that one's paying 10.5% per year. So it's paying a little bit more, but what you're giving up is the call features and then less of the barrier. This is another one. This one's just kind of crazy. Again, I'm showing these for examples, not that I'd go out and buy these. Lesser of the S&P 500. The XOP is the oil and gas explorers or exploration production index, I guess. 3 years, 3-month non-call, 17% per year, and then the 50% coupon barrier. If you're really bullish. Yes, sir.
I have a series of questions, but if there is such a thing as an average client, do they understand this well enough to make their own decisions? Or do you guide them and then make those decisions for them? Or is it a mutual thing?
Mostly guide. I think the big part is the education. I want to make sure that they understand them. That includes, there's the upside and then also the risks of what's involved. And the risks being, these are like a bond, they're backed by the issuer. So if the issuer has trouble, Citigroup, I wouldn't think so. Remember 2008, I don't know if anybody ever saw the movie The Big Short. I mean, there is that. So I wouldn't go out and buy one of these for the total portfolio. The other risk is the liquidity. This isn't there. This isn't something that you trade like an ETF or a stock. But getting back to your question, yeah, this is certainly something that we would like to sit down and talk to people individually about to make sure they fully understand, give the education to make sure they understand the pros and the cons, how these would work, and what could possibly go wrong.
Right now, I don't know if I'd ever totally understand it.
And they are very complex. I've explained these to some people, and they're like, how does this even work? The big part is, and the income notes are a little more, and the way we work with our clients, most of them aren't looking for income in this manner. So this isn't, we focus mostly on those buffered notes that provide the buffer because they're so straightforward, and we can tell you exactly what you're going to get at the end and track those. I do mention these, though, getting back to the barrier notes, I think are interesting just because they do have a larger upside participation. Yeah, you do have the risk of losing money on the downside. But I think, again, like I said before, we're down high teens. Not to say it can't happen, but the market would really have to be down 60 or 70% over a few years. I see that likelihood as being very slim. The other part of this, too, is, obviously there's issuer risk. I would look to diversify these and do a number of different, just like you diversify a stock portfolio.
Here's a question about I-bonds and how they're doing and if they're worth it.
Yep, we'll get to that. Thanks, Charity. And I would kind of mix and match these as well in a portfolio because they do different things, especially with the barrier notes. The last one I want to show here, too, are the protection notes. So there's growth tied to underlying indexes. These are probably the simplest to understand. The growth is capped. There's downside protection can vary, but oftentimes it's zero. These can be callable or non-callable. So here we have the 2-year note, S&P 500, Dow Jones Industrial Average, 100% participation, but it is capped at 13.65%, 100% principal protection. Very straightforward. the market goes up 20%, you make 13.65. If it goes up 5%, you make 5%. If it's down 20%, you still get all your money back. This other one is tied only to the S&P 500, 3.5 years. It does have a call on it at 1 year. So Goldman Sachs can come in and say, okay, we're calling this just like they would a bond. The premium, they will pay you 6.4% on that. If it is called, and again, this has 100% upside uncapped and 100% principal floor. This one is fairly risk-free. Just have to really tie your money up at 3.5 years. Like I said, it's usually liquid at any time. It's just a matter of what you'll be getting in the market. It might be that the market's up. There's options that are used on the underlying. So if the market's up a bunch 1 year from now, you probably won't not see that same return if you decide to sell this prior to maturity. So I guess in conclusion, and we can answer some questions here, we don't think we're currently in a recession. We do expect to see a recession 2023 or 2024. The historical stock market is varied. It doesn't always go down during a recession. It sometimes goes up. It may not go down that much. We've seen quite a pullback already this year. Technically, I guess you could say that we hit the bear market mark in June. The market saw its highs in, very early January, first couple of days of the year. So we're coming up on September, so we're almost 9 months into a bear market. It's average bear market's anywhere from 17 to 18 months or so. So if this is typical, we're already half the way through, so we could still see a recession. The market could recover during it, but if you are worried about what's going on, it may not hurt to look at different strategies for protection. Again, I'd look at these in lieu of the bonds. Instead of the 60-40 stock bond split, I would still keep money in the stock market, the money that you don't need to touch, but especially if you have short-term money or if you're nervous, there's other strategies to consider. Charity did pop in with a question. It had to do with I bonds. That's the bonds that you buy directly through the Treasury. You're limited to $10,000 a year. Those are doing very well. They do adjust every 6 months. So right now I think they're paying over 9%. So they're
we just bought some recently. It was 9% for 6 months, kind of like an introductory thing, and then it will be adjusted for a more normal amount of inflation, but who knows what that is.
Well, and if inflation stays high, it'll probably stay. Yeah. So I think those are a good way to go. Like I said, you're limited. You also have to be aware of what you give up. You don't hold them for a year. Then if you sell them within 5 years, I think it's 3 months interest that you're penalized. So kind of like a CD or other sort of savings bond. Any other questions that I can answer?
I guess slightly, because the country has never spent, hasn't created money as much as they have in the last few years. Even after the war, Second World War, they created a lot of money there. So this is like an unprecedented amount of creation of money. And do you think that will have it seems like it's an abnormal amount of money creation, so it seems to me like if you have an abnormal amount of inflation or length of inflation, more impact, it just seems like, I know if we increased our personal spending by 700-800% for a few years or more, that would have some kind of long-term impact.
Fully agree. And I think that's why we're going to see inflation for quite a while here. There has been so much money creation. The government's continue to spend. And I think that we're going to be caught in, everybody. So if you remember, the inflation rate that's reported by the CPI is year over year change. A lot of this is sticky. Whatever's happened has already happened. Prices aren't going to go back down. Energy prices will fluctuate, but a lot of other prices, people are very unlikely to drop them. And so this year-over-year number may not change much, but there'll still be inflation. And I think, we've been running at, say, 8% year-over-year change. We could see that fall 6, 7, maybe even 5. But our long-term average at 2 or 3% is, I think it's going to be a very long time before we see that again. And to my earlier point, too, the Fed's doing what they can to raise interest rates, but that doesn't impact any supply constraints, whether it's supply chain or just the goods. We look at what's happening in Europe with energy prices right now. The Fed cannot control that. They can control the money supply, but the government continues to spend money. So I think we're going to see a lot of inflation here for foreseeable future.
Yeah, excuse me, I don't,
I wanted to ask about future real estate prices. I think they're going to come back down a little.
I do. I saw an interesting article over the weekend from Moody's Analytics. They rate bonds and do a lot of analytical work. They were talking about how some of these real estate, or a lot of these cities and their real estate markets are overvalued by just a lot. They talk about Boise is overvalued, they think, by 72%. But what they said is that they think prices will drop, but not by that much. They won't hit equilibrium. We'll see drops of 15 to 20% in some cases. And this is their prediction, and I don't necessarily disagree with it. We could see prices drop 15 to 20%, but still obviously be overvalued. A lot of it's fairly simple math too. If you look at where 30-year mortgage rates are today, call it 5.5%. They've been a little lower, a little higher. With what real estate prices have done the last year, that payment, when people go out and buy real estate for their homes, they're looking at the payment, not the overall cost. That payment's double what it was a year ago. Wages have not doubled in the last year. So yeah, I do think real estate prices are going to drop. It'll depend on locality. I think some places, especially the coast, will probably get hit harder than others. I don't think we'll see the real estate recession that we did back in 2008. I think the lending standards are much higher than they were. The banks are better capitalized. But I think overall we're going to see real estate probably at least moderate prices.
Could you repeat the questions?
Yes.
That they asked you?
Yep. Thank you.
He threw out the 700-800. Did government spending increase 700 to 800%?
Depends how far back you go. Yeah.
I'm talking just in the recent past that we're talking.
Here we can show you.
Because I mean, that's 8 times, right?
So if we go back, well, let's just look
Let's just go
pre-pandemic.
back to 2020.
Yeah, so pre-pandemic,
Mm-hmm.
we'll say it's $1 billion, so that's about $5 trillion. Government spending had gone up to about $9 trillion, less
So it's less than 200, less than 100%.
than 100% at that point.
The numbers get thrown around so much that you really can't. You listen to the statement, and so we didn't increase by 800%.
Except if you go back, this is
Yeah.
back 20 years.
Right, but 20 years is a long.
Yeah, and it has gone up.
Usually they don't say since 1950 we've increased. It says, well, he's done that. The government's done that just since the pandemic. We got all this extra cash, 800%. Well, anyone who knows numbers that's not
No.
a likely number to throw.
No, yeah, that is. And a lot of it was temporary. And you can see that the spending is obviously much above trend, but not the 700 or 800%.
and that's on the books, like off book spending, how many trillion is it up?
Right.
You know what I mean? That's, now you got what? I can't remember, we went and saw, what's his name, the speaker that not too long ago.
David Walker?
Yes, and
Yeah.
I can't remember he was saying like that what's off the book, the total is like 130 trillion or something like that.
It's a really big
So
number.
it's, I don't care what you think, we're not getting the full picture, I mean.
Right.
At least it's a very scary picture, so.
The other part that I'll mention too, so this is federal government spending. A lot of the municipalities, states have increased spending quite a bit too. I mean, you always see the headlines that talk about having to cut back and stuff, but if you look at the numbers, they're spending more. I know property taxes are going up around here. I mean, that's who really likes what's happened with the real estate market, or the county's charging property taxes. Any other questions I can answer today? I do have to put in a plug. We do have Becky Swansburg coming to speak. So it's Thursday, October 13th, at the Doubletree in Bloomington, right off 494 down there. She's really talking mostly about overall retirement planning strategies. It's real good to get us into taxes and some of these other things too. I think it'd be worthwhile to spend a few minutes, and we are giving away her book too that talks about this. So let us know if you'd like to attend. All right, thank you all for coming.
All right, yeah.
Enjoy the rest of your day.
I'm back to work here. Hey, there's just a lot of, it seems like with the income nodes, barrier, buffered, it's kind of like, they've got buffered ETFs are not that old, but there's so many, and there's the companies from Goldman Sachs, that everybody's got their own underwriting index. There's just more and more of that now.
There is more because I think people are looking for bond alternatives. So when I was at US Bank, we used to do a lot of this stuff too. We would go out to these companies, buy the same things, and they're all bidding. But I think now people are looking beyond bonds. This is the type of stuff that they're looking at, so there's a lot more demand than there was previously. Yeah, and it's interesting. And like I said, I like to mix and match. To be honest, what I like to do is mix and match like the barrier notes with the buffered notes. So that way, if something really does go south, you still have some protection. But then with the barrier notes, you also have the added upside too. And so you start to look at it, you really can't lose. With the buffer, you're not going to lose as much on the downside. I always try to look at the extremes. What if the market's up 100%? What if the market's down 80%? With the buffered notes, you wouldn't be down as much. But then the other one too, where you're getting a higher participation rate, if the market's up a lot, you'd be up. Even with the cap on the buffered notes, you'd still be up even more. So.
And then one of the buffered ETF by or monthly one, there's the deep and the shallow. Do you look at that and say, wow, okay, come the date here, this is already down to 5%, so why wouldn't I go ahead and buy it the day after that, the next month, for that next month, so that I'd already have that extra 5% that I could go up, and then I have the buffer. So, are you looking at those and just like, well, I'm going to buy an August or a September. Obviously, I got to keep it for a year to realize that.
Or it can cap out. So maybe the market takes off, 3 or 4 months and you're moving out of it. I did a lot of that. So we run our buffered ETF portfolio where we're moving these things around, generally about monthly, sometimes 6 weeks. About a month ago, I looked at it and we had some stuff, that it come due, just rolled over from June and July. So it was resetting. But I looked at the March and February deep stuff. And yeah, it was down the 5%. So I thought, okay, there's no more downside risk on these. I guess there is if the market drops more than 30%. And then you have even more. So we rolled a bunch of stuff into that to take advantage of it at that time.
Okay, so you actually look it back and say, well, the January one, you'll buy the January.
Right.
Like now.
Mm-hmm. Yeah, we're doing that all the time. Then what happened a few years ago is these things were capping out. So they'd hit the cap 3 or 4 months prior to when they're coming due. So there's no more upside. And the market could still drop a bit. So we were moving out of those and rolling into something else. So yeah, a lot of active management on those. So cool. All right. Well, thank you for coming out today.